Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Valeura Energy, Inc. Please note you can submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Robin Martin, Vice President of Communications and Investor Relations of Valeura Energy, Inc., which trades on the OTCQX Best Market under the symbol VLERF and on the TSX under the symbol VLE. Welcome, Robin.
Thanks, Matt. Good to be here presenting at the Virtual Investor Conference. So today I'll give you an overview of Valeura Energy. Before I start, just draw your attention to our disclaimers and advisories slide. This is slide 2 in our deck, which will be available online later today. In particular, I'd ask that you take a look at the cautionary language around forward-looking information, as I may use some forward-looking statements in this presentation. So at a glance, Valeura Energy is a Canadian upstream oil and gas producer. We have production of just over 20,000 barrels a day. The company has 5 operated assets. 4 of those are offshore oil producing assets in Thailand, and 1 is a non-producing appraisal exploration play in Turkey. It's a potentially large tight gas play, one that we're very interested in, but the bulk of the discussion today will be on our producing assets in Thailand. So if you haven't looked at Valeura in some time, say over the last 2 years, what you'll notice is fairly significant change in what our portfolio is. And on the back of that's on the back of 2 major deals that we did over the last couple of years, one in 2022 and one in 2023, which has really transformed our portfolio into one that is highly cash generative with that production backbone and some very strong margins to boot. So I'll go through some numbers in a moment, but just at a high level, let me say we've got cash in the bank, we have no debt. We're poised for further growth, both through M&A success and through organic developments in the portfolio. Thought I'd touch on capital markets just to get the ball rolling here. So from a structure perspective, we have 103 million shares outstanding. It's a very simple capital structure. We don't have any converts, we don't have any warrants, nothing like that. Our shares, as Matt has mentioned, trade on OTCQX and on the Toronto Stock Exchange. Combined, we've got average daily trading volume of about 700,000 shares per day, which creates an opportunity to build a significant position just on the open market. Looking at our shareholder base, our largest shareholder is Baillie Gifford. That's a large blue chip institution based in the UK. They hold nearly 17% of the company. Number 2 is Thoresen Thai, which is a conglomerate holding company based in Thailand. They hold about 13% of the company. And I'll also mention our executive and board, who hold nearly 6% of the company. At current share prices, and this is a couple days old already, 325 Canadian per share, but I'll switch to US dollars for everyone's convenience here. That equates to a market cap of about $250 million US. And with $151 million in cash in the bank at the end of the year and no debt, that translates to an enterprise value of $100 million thereabouts. So my job for the rest of the presentation is to show you how much value I think there is over and above that $100 million enterprise value that we currently have. I will note share price performance has been strong over the last couple of years. The graph shown here gives you performance from the beginning of 2022, and what we can proudly show is 650% increase in share price. Just touching on our strategy briefly, as I've mentioned, we've grown significantly through acquisitions that we've done over the last couple of years, and inorganic growth remains part of the strategy. We continue to look for value accretive opportunities in our core region in Southeast Asia. And that value accretive word is particularly important. We're not interested in growth for growth's sake. We're interested in adding value, and M&A has presented an excellent opportunity for us to do that, and we intend to do more. At the same time, the sorts of assets that we're interested in are things that generate cash flow in the near or immediate term and also provide the platform for further organic growth. So with that, what we're looking for in an acquisition is assets that also give us some opportunity to reinvest into things like exploration, further development, commercialization of unloved parts of an asset, or that sort of thing. Equally important to the two growth pillars in the strategy is focusing on what we call operational excellence. And what I mean by that is not losing sight of what it is to run an oil and gas company properly and efficiently. It means having an executive team that have the proven expertise in both operations and in M&A. It means focusing on margins and operational efficiency. And it means maintaining a strong license to operate with the communities where we work. Speaking of the team, here's our senior executive team based in Southeast Asia. I'm not going to read all the words on this slide. There's a lot, but there are a couple things that I want to point out. First is the mix that you'll see between large companies and small companies in our team's history. We think that is particularly important in that large companies tend to provide that sort of grounding in the importance of HSE, in corporate governance, in adherence to policy and procedure. However, we also feel equally important to have backgrounds that tie to small companies where the entrepreneurial spirit can flourish, where creativity comes to the foreground, and that sort of thing in the way that we execute our business. So that mix of two things really kind of defines the character of our executive team. The other thing that I would point out on this slide is just how international this group is. If you just scan your eyes through, you'll see Indonesia, Malaysia, Thailand, broader jurisdictions in Southeast Asia and the Asia Pacific region, as well as various other international jurisdictions. To get an all-star team like this with this sort of international expertise and particularly a focus on Southeast Asia is really a unique occurrence. So we're very proud of the team that we've assembled here. Just stepping into the assets to give you a little bit of an overview of what we actually have and what we actually do. And maybe I'll start by just offering some comments on Thailand in general as an operating environment. So what we're looking at here is assets within the Gulf of Thailand. It's relatively benign operating conditions, shallow water between kind of 45 to 75 meters. There are no boundary disputes that affect any of our assets or anything near us. Services are provided locally. Thailand has a long established and large oil and gas industry, and with that also comes a very well-educated workforce. As a result, the vast majority of our operations are run by Thai nationals. I think in our 200-strong office in Bangkok, for example, we have something like 3 expatriates. So it is very much a business that's run locally in Thailand, and we intend to keep it that way. Just looking at the assets, there's 4 assets listed here, the first 3 being the result of the acquisition we did from Mubadala Energy. Manora is a late life asset that keeps on giving, frankly. It is probably the most mature of the assets in our portfolio, and at a glance it looks like we've probably got 3 years or so left of production life. However, with work that we've done over the last couple of years, drilling infill wells at Manora, we have in fact encountered more oil than anticipated, including some dry oil contributions. And we currently rely on this asset for a little more than 4,000 barrels a day on a gross basis, or call it 3.2 to our working interest share. On the back of the work that we've done on this asset over the last couple of years, we do anticipate more drilling potentially as early as later this year or into 2025, which can further extend the field life. The Jasmine Field is our largest producing asset. This is currently generating about 8,500 barrels per day. And the key story with the Jasmine asset is this is a field that is greatly exceeding its expected ultimate recovery. I'll go into a bit more detail on that in a moment. It is a very important characteristic, and in fact, it's a characteristic that applies to all of the fields in the Gulf of Thailand, but is especially apparent when we look at Jasmine. With a field of this size, there will always be something of a capital program, and this year that takes the form of some drilling in the second half of the year, which could be about 15 wells, as well as some interesting projects to drive a little more efficiency into the asset, including greenhouse gas emissions abatement. Nong Yao is a very interesting field for us and an important source of growth. Pardon me. Important source of growth for us in 2024. Within the coming weeks, we'll be sailing out a new facility to the Nong Yao field, which will serve as a platform for commercializing a new accumulation that's associated with this field called Nong Yao C. As a result of that, we anticipate increasing production here. So this is the organic growth I've been referring to. Increase is targeted in the order of 50%, which would entail bringing production from the order of 7,000 barrels a day up to about 11,000 barrels a day, our working interest share. There's also exploration wells planned on Jasmine, I should have mentioned, and one on Nong Yao. The Wasana Field is an interesting one for us. This was the first asset that we acquired in Thailand. We had envisaged bringing this field on at about 3,000 barrels a day and very quickly drilling to more fully commercialize some known accumulations, which would bring production up to the 4,000 to 5,000 barrel a day range. That drilling is underway now. I expect we'll provide an update to the market when that's been completed. Probably more interesting when it comes to the Wasana Field is results of the work that we've done last year. We drilled a couple of appraisal wells further out from the main field area, encountered a deeper oil contact or deeper oil than had previously been mapped for this field, and as a result, reimagined what the potential of this field is. We've told the market we anticipate about 20 gross additional well locations for Wasana. There's currently no reserves associated with that, but I expect when we come out with a new reserves report, we'll be able to define the size of the scale of the opportunity set there. Just taking a look back at 2023, and this slide gives you what I feel is actually a pretty boring chart, and I like boring charts. The intent here is really to show you the stability and predictability of the production base that we've built at Valeura. In 2023, this is 20,400 barrels per day, and as a result of this production with strong margins, in fact, strong margins based on price realizations of about Brent oil equivalent or even a little bit better than that. We've generated cash, we've fully repaid all the debt that we had, and we've built our cash position in the bank to $151 million by December 31st. Just another way to look at 2023, we published some guidance at the beginning of the year and very quickly revised that guidance to increase the production target and decrease expectations on spending. So that revised guidance is shown in the left column of the slide here. The green in the middle is just an affirmation that we have delivered production within the range that we specified. We've delivered OPEX within the range specified, and our CAPEX actually came in below the range. Doing what we promised is the intent here. Looking forward into 2024 now, this is again another way to look at the growth that I've described. We have put out a guidance announcement specifying production expected of between 21,500 to 24,500 barrels per day. Again, all oil, all tied to Brent, and all coming from the Gulf of Thailand. OPEX of about the same as it was last year, but with higher production, what we'll see then is the unit OPEX rate should come down a little bit, and CAPEX in the range 135 to 155 million, which is below our target guidance range for last year. Now, I will mention on CAPEX, I still feel this CAPEX range is a little bit higher than one might consider normal maintenance type CAPEX for these assets, and that's on account of having the Nong Yao C development as part of the program in 2024. So just going back to a comment that I made earlier on the Jasmine field, and this being a field that is greatly exceeding its expected ultimate recovery. To put that into numbers and drawing your attention to the chart on the bottom right of the slide, In 2005, when this field was originally developed, it was envisaged that this would have recoverable volumes of 7 million barrels. Now, fast forward to May of 2023, and our team celebrated having produced the 90 millionth barrel from the Jasmine field. So 7 going to 90, and at that time, still, we saw 10 million barrels of 2P reserves as of the end of 2022. So the question is obviously, how is this possible that it has exceeded expectations to such a huge degree? And the answer really lies in the geology, which is that very colorful plot to the left of the slide. So I'll walk you through just a couple of things to note from that picture. The red slivers that you're looking at are individual reservoir intervals. The black lines are obviously individual well bores. So the first thing to note is that individual well bores would typically access multiple stacked reservoirs. And what that means is when an individual reservoir reaches the end of its producing life, water is out, stops being productive, it is possible to plug that off, move up hole, perforate a new interval, and have new production again from the same well. That can happen multiple times with a single well bore, and when a well bore is finished and there's no further reservoirs to access through that particular string, the slot can be reused for drilling additional wells. What we typically choose to do in that sort of instance is drill an infill well in adjacent fault blocks, which have very similar looking geology, very often exactly the same reservoir strata, just separated by a fault to the side. What that means in a reserves evaluation sense is that those new volumes from an infill well, even though we might believe them to be there and even be able to image them on seismic, cannot be included as part of a reserves assessment because they haven't been penetrated by a well. So with further infill drilling to access more of these look-alike fault blocks next door, we can continually add to that reserves picture and increase the expected ultimate recovery from the field. Of course, eventually you get to a point where you've reached all you can from a particular platform, and that's referring to the top part of the slide, new wellhead platforms being built to access further out fault blocks. Indeed, on the Jasmine field, we've got 6 fixed installations, which is just a reflection of the maturity and the potential that has been accessed through this field. You see an interesting dynamic when you stack all of the fields together, and they all have this characteristic to a large degree, but putting them all together, you get a picture that culminates in the end 2022 2P reserves that we've shown here of 29.1 million barrels. One of the criticisms that we get from people who are new to our story is 29 million barrels. Okay, that's fine. Annual production of, call it 7 or 8 million barrels. That looks and feels like it's a short reserve life index of just 3 to 4 years. However, if we rewind the clock back by a year, what we find is reserves are about the same, meaning, yes, we've produced 7 or 8 million barrels, but we've also added 7 or 8 million barrels. The year before that, production about the same, additions a little more. Year before that, production about the same, additions a little less. Point being, every single point in this graph that we look, we would see about a 3 to 4 year reserves life index on account of that dynamic that I've described earlier, which is adding infill wells, doing workovers to perforate new zones, and maintaining facilities so that we can keep production broadly flat. Again, that boring production chart that I showed earlier. So it's important to note this isn't a perpetual motion machine. This doesn't go on forever. Every field is finite. You do hit end of field life at some point. However, what's important to me when I look at this portfolio is as long as we have assets in the portfolio that are on the less mature end of the spectrum that provide opportunities for further growth and development, we have ample opportunity to keep this trend going into the future. And as I've already alluded, the Nong Yao field is an excellent example of that. So this year, a lot of excitement amongst our team. Over the next couple of weeks, I expect we will sail out a new piece of infrastructure to be installed at the Nong Yao field. That's identified in the right. It's labeled MOPU, which is Mobile Offshore Production Unit. That will be tied in by pipeline to the existing infrastructure and will serve as the wellhead platform for drilling 9 wells, 6 of them producers, in order to commercialize an extension of the field that we call Nong Yao C. So on the left, you can see that with the yellow shaded reservoirs. Importantly, as I've mentioned, this has a direct impact on production and will increase production rates there up to a target of 11,000 barrels a day, our working interest share. Also, there's more to be done at Nong Yao. And you can see the dotted area on the left of the map, the pink shaded reservoirs, is an area that we've called Nong Yao D. I expect we'll do an exploration well there in 2024 in order to start sizing up the next potential accumulation that we could develop at Nong Yao. Exciting times, an immature asset with lots of development opportunity. Similarly, I've mentioned the Wasana Field, initially meant to be 3,000 barrels a day, going to 4,000 to 5,000 barrels a day, our working interest share. During 2023, when we pieced together the subsurface teams of the businesses that we'd acquired, the team came to the management and ultimately said, we believe there to be significantly more oil in the greater Wasana area than you will ever commercialize with the existing infrastructure you have. So the proposition at that time was to drill a couple of appraisal wells in order to size up just what that potential looks like. We did that in 2023 and have since announced to the market we foresee 20 additional gross drilling targets at Wasana, which obviously can significantly increase the reserves and the production base in this asset. Now, there are no reserves associated with those locations until such time as we put out a new reserves report. I expect that will be happening in the coming 2 months, and we'll be able to articulate to the market just how big we think this opportunity is. In parallel, what we've done is start a project to select the right concept for how best to redevelop this field. And I would expect we'll be in a position to take an investment decision on that at some point this year. All the while, focusing on growth is the key for the business. However, we're mindful of the responsibilities when it comes to maintaining sustainability of the business. There's some very interesting things we're doing on all fronts of environment, social, and governance. We are very keen to articulate those to the market, and our commitment is to increase transparency on this front. We will publish our inaugural sustainability report this year. I feel it's important to note that we do trade at a significant discount to our peers. So the top graph here shows you the divergence in share price of Valeura versus our peer companies. You can obviously see what the impact of having done our acquisitions and having gotten broader market recognition has done for shareholders that have been with us for some time. That's that 6.5 times increase that I was referring to before. Even still, on just about any sort of trading peer comparative that you might use to assess the company versus our peer set, we come in at the lower end of the pack. So shown here is enterprise value per EBITDA, enterprise value to production, enterprise value to 2P reserves. And on all of these metrics, the point is we have ample opportunity for additional share price appreciation with our current portfolio and business. So just by way of summary, a few very quick bullet points. Material cash generative production with embedded asset and operational upside. We have an experienced team, frankly an all-star team, who have significant expertise in both the operational side of the business as well as in M&A transactions. We have a growth strategy that has delivered top-tier shareholder value and is poised to continue doing so. The market dynamics, we believe, in Southeast Asia are suitable for additional M&A. This is why it remains part of our strategy. We see additional opportunities that we can be chasing there. And we're undervalued and trading at a significant discount, both to fundamentals and to our peers. So with that, I'm going to open up the Q&A box and just see what we've been asked here. Just bear with me a minute while I sort these out. So first question is on our shareholder base, and the questioner notes that about a third of the company is owned by 2 major shareholders, and the request is discuss which direction they would like to see the company go. For example, are they ESG focused? Are they interested in more oil? That sort of thing. Let me touch on that. So the major investors that we have, and I'll mention Baillie Gifford has just yesterday announced an increase in their share position. They bought more shares in January. I obviously can't speak for them. There is an expectation on behalf of our shareholders that we adhere to high standards when it comes to environmental, social, and governance responsibilities. Part and parcel with that will be us enhancing our transparency by way of the sustainability report and being as upfront as possible, particularly on matters of governance and whatnot. We take this very seriously, and we're pleased to have a good working relationship with both those major shareholders. I don't see a major push for us to transition our portfolio away from oil and gas. That said, we are mindful of our greenhouse gas emissions footprint, and I would like to see us reduce our emissions intensity. Part and parcel with that would be adding gas to the portfolio. We do like the idea of having a gas producing business in Southeast Asia, partly because of the lower environmental footprint and partly because of the natural hedge that having gas in the portfolio would create against an otherwise oil only portfolio. Hope that answered the question. Next question. Have you considered implementing a dividend? And I'm going to bundle that together. Actually, there's another question follow-up. I knew this was coming, or a share buyback. And listen, we historically have taken the approach that with a strong and stable production base and high margins, our intent is to stockpile cash resources in order to support our strategy, which is growth oriented and largely predicated on opportunities within the M&A market. So we are very keen to ensure we have maximum optionality when it comes to being able to transact on additional M&A opportunities. That said, it is difficult to deny that a purchase of Valeura shares would be a good investment, and I suspect the market would take note. Now, this is obviously a board level decision to be made. Comments like this, we do feed up to the board. I suspect our board is listening. And as such, I expect that this is the sort of thing that they will deliberate on in their next meeting as to whether it's appropriate to think about some form of direct shareholder returns. As for whether that would be a dividend or a special dividend or a buyback, I don't know. I think the decision first would need to be, do we want to engage in direct shareholder returns? And if so, what mechanism? So the idea is really continue watching the M&A market, and insofar as we see compelling opportunities for value add, that would be our preference. But we also need to pay attention to shareholders, and definitely this is something that we will be discussing. Okay, an operational question. When is first oil of Nong Yao C expected? So we've put out guidance expecting, with our expectation that we should be able to have first oil by June of this year. There's a possibility it could be a little bit earlier. There's a possibility it could be a little bit later, but that would be the general target. At this stage, we don't have the facility in the field yet. I expect that's coming in the next couple of weeks. That'll be followed by a hookup and commissioning phase, and thereafter we'll bring our drilling rig in to start drilling. So a few moving parts, but the general expectation should be June for that. Okay, question on tax losses as well, and specifically, could you indicate the amount of tax losses from Chris Energy that have not yet expired, and how much of these will expire in 2024? That is a good question. We do publish the tax loss carry forwards as part of our financial results. The last public number on that would have been with our Q3 result. There'll obviously be a new number published along with our full year results, which we are expecting, by the way, for middle of March, about March 14th, March 15th. So you'll have an update there. The number is about 300 million at the moment. So another few questions that came in actually before the call, which I'll address. Looks like we've got about 1 minute left, so maybe just one of them. What sort of infrastructure would you expect to deploy for the Wasana redevelopment? And good question on this. I don't know yet. We are in the middle of a concept select phase whereby the team is assessing various different options, including new build fixed infrastructure, floating MOPU type developments, as well as the potential to use refurbished platforms. It's too early to say. I expect this is something that we'll articulate at the time that we're taking a final investment decision on this. With that, I think we are pretty much out of time. If there are further questions, I'd invite you to register for a one-on-one meeting. I'm happy to take those over the next few days, or reach out to me using the contact information that's on the screen now or on our website. So with that, I'll thank you for joining us, and